Hello, I'm Chris Pedersen, and this is Stock Watch on Wednesday, the 31st of January, 2024. All advice is general advice and might not be suitable for you. Always consult your advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. Few market observations from this week. ASX 200 keeps rising slowly and steady. It's near new highs in my view by the end of the year. My expectation is we'll see 8,000. The Aussie dollar is steady right now, around 66 US cents. Oil creeping up, but still it's going up slower than we would expect with all the Middle Eastern news. This is due to record US oil production. Here are some interesting charts. Oil manufacturers and how much they've moved the past year. This is a chart of the U.S. 10-year bond versus the S&P 500 earnings yield. Now, the earnings yield is the P/E ratio flipped upside down, the reciprocal. Thus, if the P/E is 20, that means the earnings yield is 1 over 20 or 5%. What this shows is that when the earnings yield versus the 10-year bond yield is low, that tends to reflect the market going up because equity markets are not priced off of current earnings, but priced off of 1 year forward earnings. This chart shows inflation rates of some of the top countries in the world. What you see is Australia right now, of developed countries, tends to have the highest inflation rate. However, what we know is it's coming down pretty quickly, but not as fast as the United States, which is already down to like 3%. This is a chart showing ETF money flows in versus money flowing into unlisted funds. Guess which one are the ETFs? ETFs have been soaring over the past decade, and this trend is only going to continue. Thus, if you're an advisor or an investor, you really do need to look at exchange-traded funds because that is where the money's going. That is where the smart money is looking, and this will continue to grow over time. This chart shows China Evergrande Group. Well, surprise, it's crashed, now it's bankrupt. This chart shows the S&P 500 in the US, the Korean stock index, and the China stock index. The S&P 500 is the black line that's performing really well. Then you see China and Korea. China is the worst performer. So looking at countries and their indices, this is something that is absolutely fascinating, and you've probably been asleep at the switch, but this really is important for you to pay attention to. This chart shows the Nikkei 225 index. I have it going back to 2012. It has almost been steadily upwards. Now, a lot of people have ignored the Japanese market because for decades it performed flat. It had no growth. They had no inflation. The economy was just stagnating. However, this chart shows that while you were sleeping, China has been going down and Japan has been going up. Here's the Shanghai index. See what I mean? It's going down. Here's the Hang Seng index, which is Hong Kong. This has been going down. The ASX 200, now this is the accumulation index, and it's been doing all right. It's going up. This is a 5-year chart. So Australia's doing much better than Hong Kong and China, but it's not doing as well as the S&P 500, which is what we see here with this chart. The S&P 500 has been a stellar performer, but there's one index that has outperformed all others of developed economies. This is the NASDAQ index. Now, the trouble with the NASDAQ index is it's very volatile. If you take a risk-weighted return for the NASDAQ index, because of the volatility, it has a higher return, but the S&P 500 has a better risk-weighted return. Both of them are fine if you're investing long-term. Two companies I wanted to share with you on the ASX this week. First one is Harvey Norman. The code on the ASX is HVN. It's currently trading at $4.33. This is a 5-year chart. Now looking at it, you go, well, why is Chris showing me Harvey Norman? We've been looking at Harvey Norman for 20 years. It's never been a stellar performer. In fact, it's kind of boring. and you look at it, it's been trending downwards. So why should I look at Harvey Norman? This is why. The revenue growth rate estimated from 2024 to 2026 is looking at around positive 6.6% per annum. However, during this time, the earnings growth is over 12% per annum, and the dividend growth per share during that period is 13% per annum. These are all solid numbers. Harvey Norman is not stagnating anymore. Now, the PE on the 2025 earnings per share estimate of 34.5 cents is only 12.5 times. This is cheap. This is primarily because the market doesn't believe Harvey Norman can deliver. They're so used to Harvey Norman stagnating. Now let's look at the yield. On the 2025 dividend estimate of 24 cents, that's a yield of 5.5%. That's very attractive. Free cash flow is strong at over 5%, and the payout ratio is only around 67%. I would like it a little lower, but fine. 5.5% yield does give you a free put, which means it reduces the probability of downside. So overall, this is a tired, non-performing company, but no more. Surprise. It is cheap on a fundamental basis. I rate it a buy. However, there's a caveat here. You do want to watch it to make sure that they're delivering on these earnings per share growth numbers. We're coming into the February reporting season. Harvey Norman is one of the ones I'm going to be looking at closely. IAG is the second stock, code IAG on the ASX. It's trading right now at $6.03. This company, you're looking at a 5-year chart, has had a pretty bad history. It really crashed. And it's understandable. Insurance companies have had a very difficult time for a few reasons. One, they sit on a lot of cash and they earn money on the interest. When interest rates are low, insurance companies earn less profit off of that cash. Two, storms are getting bigger because of climate change. And as the size of storms get bigger, the loss amounts that they pay out get bigger. Now, there's a whole restructuring happening in the reinsurance market. Insurers, they can't afford to insure all of these catastrophes that are hitting Queensland and other places in Australia. They reinsure, which means they share the risk with global insurance companies. They're called reinsurance companies like Swiss Re, General Re, Munich Re. But the storms are getting so big in Florida in terms of the damage bill that even the massively capitalized reinsurers can't afford it anymore. So there's what's known as catastrophe bonds, which helps to share the risk with the entire global capital markets. Now getting back to IAG, we do see that IAG the past year has been performing well. Let's look at the numbers. 12-month price target is $6.15. This is a price target from Jardines. Now another thing is IAG is not a small company. It's $15 billion in capitalization. The revenue growth rate is estimated from 2024 to 2026 at 6.4% per annum. However, the real story is the earnings growth rate. Earnings should grow around 20% and the dividends should grow around 26%. This is a stellar performer. That's if they don't have massive storm after storm after storm that they have to keep paying out on, which, statistically speaking, insurance companies, they price policies off of all the statistics, and they're getting much better anticipating storm bills, damages, and frequency. The PE on the 2025 earnings estimate of 40 cents is 15 times. And the yield on the 25 dividend estimate of 30 cents is 5%. Free cash flow is around 6.5% and the payout ratio is 70%. It's an insurance company. It's a tough business to get right. However, they're doing a pretty good job the past couple of years. Insurance companies globally are getting a handle on these damage bills. Biggest problem is not here in Australia, but it's in the state of Florida. Some of these storms have been having $200 billion bills to rebuild. I mean, that's just beyond comprehension a few years ago. That's one reason why the state of Florida has an insurance crisis, because insurance companies are raising premiums so much that people can't afford insurance anymore. Let's hope that doesn't happen here in Australia. With all this said and done, it has good growth, but this price target at 615, the stock is at 603. I think that price target is low. I rate it as a buy half weight right now, simply because of the trend in premiums going up, and here in Australia we are captive and don't have a lot of competition, so they're going to get away with these price increases. As always, if I covered anything and you want to learn more about it, send an email to stockwatch@fnn.com.au and address it to me, Chris Pedersen. Hope you have a profitable week. Thank you for your time.